Well, good afternoon, everyone, and good morning to those of you out on the West Coast. My name is Chris Hershey. I am a financial planning analyst here at eMoney, and I'm looking forward to walking you through the eMoney Fact Finder over the course of the next 4 weeks here. Before we dive into today's session, which is going to be all about the assumptions, just want to go over a couple housekeeping things. Please make sure that you are on mute. So if you're joining, just check and make sure that there's not any noise coming from your end into the audio conference. Also, there will be some Q&A time at the end. So as we cover these topics today, please feel free to shoot me your questions via the chat box. I will be taking a look at those, and hopefully we'll have some time at the end to answer any questions that you have. Lastly, just a reminder, this is a recorded session, so if you really liked what you saw here today and you want to watch it again, be my guest. That will be available to you on the EMX University website, so you can go back and take a look at this again. So as you can see, the title for today is Just the Facts, Ma'am, a deep dive into eMoney's Fact Finder. And we're working on assumptions today. Those of you that understand this reference, congratulations. Probably those of you that are a bit more tenured than others would remember Sergeant Joe Friday and his expression, just the facts. Relevant here because we're not going to get into the planning functionality of the tool as much. We're not going to get into interactive tools. We're not going to get into aggregation. We're just going to focus on the fact finder, and really the goal here is to go over each fact and give you an understanding as to how it affects the cash flow simulation. There's a lot of different variables that you're putting into a fact finder, and it's important for you to know how those are impacting the plan. So that's really the focus here. We want to make you eMoney experts and really know what goes into the cash flow output that you get when you use eMoney Advisor as your planning tool. So as I said earlier, this is a 4-part series. So today we're going to be understanding assumptions. Next week, we're going to work on building the balance sheet, focusing on property. So that's going to be real estate, personal property, and protection, insurance. And then the following week, we're going to work on portfolio assets. So what you need to know about 529 plans, stock options, annuities, all these things that you enter in the facts, how are they going to impact the cash flow simulation? And then the last part of the series is all about getting the flows right. So entering income, entering expenses, buy-sell transactions, transfer flows, all of those things. So we're going to really take some time and dig deep and get into each one of these topics. So if you are not someone who really wants to get into the details, maybe this series isn't for you. But if you really want to understand how eMoney works, how the planning function works, then I think this is going to be beneficial. So that's enough of intro. Let's get right into it. So I'm actually going to jump into a sample client here. And as I mentioned earlier, the first place we want to start is in the facts. And you'll notice we have a simple facts menu here, which is great, client-facing way to go through and look at the facts at a simpler level. But of course, we're taking a deep dive, so we're going to go into advanced today and focus on assumptions. Now, this is just one line item on this fact tree, but it really does control a lot of the output. So the first thing we're going to do is jump into investment assumptions. Investment assumptions are probably some of the most important assumptions that you're going to have here, and it's important to understand how these work. So you'll notice I am actually within a client, Frank and Joanna Miller, and I access their assumptions right here. And the first thing you'll see is this blue band. This client is using individual investment assumptions. There's actually 3 layers to investment assumptions. And I'm going to jump back to the PowerPoint here, as I'm going to be flipping back and forth a little bit as we do this, because I just want to give you kind of an overview on how these investment assumptions work. So let me go to that. The first layer is your client assumptions, and that's what you access actually within the client. Anything you do in the client investment assumption level has no effect on any of your other clients. So if we're in the Millers and we're changing those assumptions, there's not going to be any effect to other clients. Okay, you should only use this when you want an individual client to have different assumptions than all other clients. So maybe this individual client wants a higher inflation rate. So you plug in 4% for them, but you want to use 3% for everybody else. The next layer up is advisor assumptions. These are set at the advisor level, and they're going to apply to all of your clients, okay, unless you have opted a client out of the advisor assumptions and they're using individual assumptions. Okay, so this is probably a good place to start, and these advisor assumptions should be used when you want all of your clients to have the same assumptions. The next layer is office investment assumptions. So if you have multiple advisors working in the same office and you want to create assumptions that are used by multiple advisors, you can set up an investment specialist designation. It's easy to do. Simply call on the customer service and they'll set you up with that. And what this allows you to do is create those assumptions at the office level, and then all of the advisors working together in your office can use these office assumptions. Okay, so let's get back into the app. And you remember, we were in the client assumption area. Okay, if we want to make Frank and Joanna use advisor assumptions, we could just click the link, and then they would be using advisor assumptions. But how do we control these advisor assumptions? Well, we control them by going out of the client and into investment assumptions. So once we're in here, you'll notice that there's a nice list of all clients that are using the client assumptions. So if we want to switch that and see who's using advisor assumptions, we can do that. If we want to have somebody that's using client assumptions switch to advisor assumptions, we can just click the button. Okay, and office assumptions can be accessed, like I said earlier, via this investment specialist tool. So if we go here, now we're working at a level where we're able to control investments across the entire office. Important thing to remember with this is if you are in the advisor investment assumptions area and there is an investment specialist who has set office assumptions, then each individual advisor needs to come in and opt in to using those assumptions. And what that's going to do is essentially delete your advisor assumptions, and now you'll be using the office assumptions. So that's sort of the structure of investment assumptions. But what can you actually change, and how do you change it? Well, to show you that, we're just going to take a look here at model portfolios. And the 3 tabs across the top really control a lot in the system. We're going to start with market indices because these are the building blocks of your investment output in the system. So what you'll see here is 46 market indices that we have built in. This is all historical data. So you'll notice we have a geometric rate of return. This is what's used in the linear projections. So all of your cash flow reports are going to be using this rate of return. There's the mean rate, or the arithmetic mean rate of return. This is what's used in the Monte Carlo analysis. And then the standard deviation is also used in the Monte Carlo. We also have the number of years we're including in the historical data, and then the last date these indices were updated. So every quarter, we get new data in and we update the indices. However, it's incumbent upon you, the advisor, to come in here and actually choose to accept the updated indices. So if there was an update available, you would see a link right here, and you would be able to click on that, and it'd update all your indices. We don't automatically update. We understand how that could affect the output of your plan, so we don't do that. But just keep in mind that every quarter, we're giving you more updated information. You can come in here and change those. You have the ability to add a custom index if you'd like. However, my recommendation here is not necessarily to add custom indices, but rather to work with the indices that we have. Now, you might be saying, okay, I'd like to work with the indices you have, but I don't agree with your rates of return. I don't agree with the historical rates of return. So let's go ahead and take a look at how you would do that. If we look at the 30-day T-bill rate, for example, we have a 3.74% rate of return, maybe a bit high in today's environment. You could adjust that by simply clicking on it, coming in here, and maybe you feel a 2% return is a little bit more appropriate for what you want to assume as your investment assumptions. You can also change the mean rate of return, or you can just estimate it, and we'll give you an estimate based on this geometric return and the standard deviation. So if we do that, the estimation is also 2%. You can also adjust the growth character. So we've established that we're going to get 2% growth for 30-day T-bill rate, but how is this growth going to be taxed? We can determine that here by putting in a growth character. Now, it would make sense that ordinary income is 100% for this type of index. If you wanted to change that, you could come in here and change that as well. So if I save this, you'll notice that now that my T-bill rate is 2%, it has an effect on the following asset classes and portfolios. So the 30-day T-bill rate is tied to cash and money market funds. So now that my cash and money market fund asset class is only growing at 2%, that has effect on my model portfolios, because all of these portfolios include cash and money market funds. So you can see what the default rate was and now what your current rate is based on a reduced 30-day T-bill rate. Okay, so let's go back to our main page here with market indices. Now, one other thing I'll point out before we move to the next tab is that when you do make a change, you will see projected show up beside the index. And if you ever wanted to see what indices are different from the defaults, you can always click on that and it will show all of the indices that are different. Okay, so let's jump to asset classes. First thing you'll notice here is use detailed asset class breakdown. Yes or no? So we have a relationship with Morningstar. We use Morningstar X-Ray to break down the underlying asset classes of mutual funds. If you don't want to use that capability, then you just make this no. And every single holding will just be assigned to one asset class. However, if you do want that level of detail, you can make this yes. And now when we pull in a total market fund, for example, we'll be able to use the Morningstar X-Ray and break that down into the different underlying asset classes. Maybe there's some large cap growth in there, maybe there's some large cap value, some mid cap, etc. Okay, so that's up to you, depending on how detailed you want to get. If we click into any one of these asset classes, we'll be able to see the market index that is controlling its growth. Large cap growth is based on Russell 1000 Growth Index. Again, if you think 8.66% is too high for the Russell 1000 projected, you can go back into market indices, you can change that, just like we did with the 30-day T-bill. Let me jump back into asset classes here. The last thing I'll show you is you have the ability to create a custom asset class. Very simple to do. Click on the link there, give it a name, and then choose a market index that will control the growth of that asset class. Just a note on this, you can only use a market index once. So if you're already using the Russell 1000, for example, for large cap growth, it's not going to be here. You're going to have to use some other index. Okay. Let's take a look at model portfolios. So we started with market indices. Each market index is tied to an asset class, and then we take our asset classes and we use those to build our portfolios. So with the portfolios here, we have some defaults. You'll notice they're slightly different now that we have adjusted the T-bill rate. We can easily add a custom portfolio if we'd like and simply build it out based on our percentages. And let me just add one other asset class in there. It's got to add up to 100. Okay. Very simple to do, and now we'll have custom portfolio 1. Now we'll be able to use that in our planning. A note on inflation here. So this is very important. You might be tempted to find something that is lower than 3.76, again, a bit high considering our current environment. However, I strongly recommend not to do this. Keep inflation at the CPI. And if that's too high for you, again, you can go back into the market indices and you can drop the CPI down to a rate that you feel more comfortable with. A couple other points about inflation, as it is very important in the simulation. I'm just going to pull up a PowerPoint here to go over that with you. Inflation controls a lot in the system. So whenever you're setting that inflation rate, just be aware that income and expenses that are tied to inflation obviously would be affected. Now, you don't have to tie your income and expenses to inflation. It's an option. So if you'd rather use some custom rate for specific income and expenses, you can do that. But just be aware that you don't have to have your income and your expenses grow at inflation, although you do have that option. Inflation also controls a number of other things in the system that you can't really see. It's under the hood, so to speak. So I've listed them here. Inflation controls the growth on the limits of the marginal income tax brackets. So for example, our current the current year tax bracket for 39.6 is somewhere around $450,000, I believe. Next year, depending on your inflation, that's going to go up. So maybe now the highest tax bracket, it was $450 this year, now it's going to be $460 in 2017. And then it's going to be $470 in 2018, et cetera, depending on your inflation rate. So that happens under the hood based on your inflation rate. Growth on the exemption and standard deduction for our income tax calculation, again, tied to inflation. Growth on the unified credit for estate planning. So the current unified credit and the estate tax exemption, okay, if you have a high inflation rate, that's going to go up each year. Important to keep in mind when you're doing an estate plan and you're looking at 2040, for example, that unified credit is going to be a lot higher than it is today because it's growing at inflation. There's also growth on ERISA limits for contributions to retirement plans and growth on the annual gift tax exclusion. Okay, so if you're using the maximum contribution for some of these entries, that's going to go up each year based on your inflation rate. Go ahead again, just to reiterate, do not change inflation to anything but the CPI. If you feel the inflation rate is too high, then just change the CPI market index. And I showed you how to do that with the T-bill rate. Okay, so that's investment assumptions. And if you have any questions about this, again, like I said, feel free to send me them via the chat box, and I will be happy to address those at the end. It's very, very important to go through here and make sure these are set up before you do any other planning. Okay. Moving on to other assumptions in the plan. So we're going to jump out of our investment assumptions and go to a client. I'm just going to pick the Millers. That's who we started with. And I'm going to go to Facts, again, working in the Advanced section. and assumptions. And one other thing I'll point out to you too, as you're going through the facts, if you're so inclined, you can use these task completed boxes, and you get that green checkbox there. So if we want to show that we're done with investment assumptions, we can do that. And on to miscellaneous assumptions. Now, miscellaneous does not equal extraneous. Okay, these are actually very, very important assumptions. It's just there's kind of a mishmash of different ones here all lumped together, so we just call them miscellaneous. But these are really, really important as well. So the first 4 entries here, just simply life stages. Do you want to tie income and expenses to different life stages? Okay, if you put in a semi-retirement age, that's great. Now you can have separate expenses or a certain income that starts or stops at that age. Excuse me. Monte Carlo affects mortality. You'll notice if I hover over this, there is an I-tip. And that goes for a lot of different things in the system. So if you don't want to listen to me ramble on and on about what this is, there's a lot of the information that I'm giving you already in the system. So you can simply hover over fields and get the I-tip and read what it says. But if you haven't read it yet, I'll just explain it to you. The Monte Carlo affects mortality is simply a question of whether or not you want to randomize death in the Monte Carlo simulation. So if you don't want to randomize death, then you'll keep it at no. That means when we run Monte Carlo, Frank and Joanne are going to live to 100 in every single trial. There's 1,000 trials in Monte Carlo. They're both going to live to 100 in every single trial. If we make it yes, now we're going to use actuarial tables, and Frank and Joanne are going to die based on those tables. So they're probably not going to live to 100 very often. Okay, that's a rare occurrence. They're probably more likely going to be dying mostly between 80 and 90. Okay, some years Frank will die at age 60. Some trials Joanna will die at age 60. Okay, so we're just randomizing death based on the actuarial tables. Now, whether or not you want to use that is entirely up to you. I think in this situation, if you're having them live to 100 and you make this yes, you're probably going to improve their Monte Carlo. So if you think about it, you know, most of these simulations, they're going to die before 100. And the criteria we're using for success in the Monte Carlo is, do they have money left when they die? And so if they're both dying at age 75, that's towards the beginning of retirement, their money hasn't run out yet, yeah, that's probably going to be a successful trial. Okay, whereas if we're running it out to 100, probably going to run out of, more likely to run out of money. So up to you what you want to do there. Just wanted to explain the different options. The probate rate, final expenses, just a percentage of the probate estate, and then final expenses, these are just a dollar amount listed on the estate reports. Okay. Let's move on to tax mode. So Form 1040 is the best practice here. I highly recommend it. We have a pretty good tax calculation. However, if you don't want to use Form 1040, you don't have to. You can simply do a flat tax, and maybe you just want to do a 20% tax for federal, state, and local. It'll all be lumped together, and that's how you like to do your planning. Okay, that's totally up to you. However, I do recommend 1040 just because it's, I think, a more accurate projection. Tax exemptions, right here, don't worry about this unless you don't want to use our default assumptions. Our default assumption is that the client, the spouse, and all the children under 18 get an exemption. Okay, if that's not the case, then you might want to override that, and I'll just show you here the I-tip. Okay. Future flat tax schedule, if you are using flat tax and you want to change the tax rate at some future date, you can do that here. Income tax carry forwards and charitable gift carry forwards, won't go into great detail here either. Simply know that if your client is coming to you and they have a capital loss from last year, you want to use it in the tax calculation for this year or for future years, you have to plug it in here. Okay, same with the charitable gift carry forward. Any carry forward from the past that you want to enter in, do it right here. Okay. Tax rates. So deceased spousal exemptions, let's say Frank was married before he married Joanna. His previous spouse died. His previous spouse didn't use their full estate exemption, so we want to show that Frank comes into this relationship with some additional exemption. We can plug that in here. State and local taxes. You have an option here to do no taxes, by state rules, or flat tax. Best practice, again, by state rule, simply because we've created every single state's income tax calculation right here in the fact finder. Now, it's not going to be specific to capture everything a particular state might capture, for example, certain deductions, certain credits, but it does do a pretty good job of giving you a close estimate. So just keep that in mind. You can do by state rules. Local flat tax rate as well. On top of that, you can do that. Future state and local tax schedule, just like in the flat tax, you can do future scheduling. Let's say your client is planning to move to Florida in 5 years. They currently live in, we'll make them live in New Jersey, and they want to move to Florida. Well, we can say, all right, well, when Frank retires, he's moving to Florida. So there we go. So now we'll be able to show that come age 65, those New Jersey state taxes are changed to Hawaii. We're going to make it New Jersey. They're not going to apply anymore because he's going to be living in Florida. So that's state income taxes. State death taxes or state estate taxes, we give you some ability to control these. You can either do a flat rate for state estate taxes. What we've done here is just gone with a 10%. Or you can use state death tax credit table. This is not state-specific estate taxes. It's different than our income tax where we actually have the state law of the state listed on the drop-down. This is not the same. What we're doing here is simply using the federal death tax credit table as the marginal brackets for the estate tax calculation. So if you want to know what that is, I pulled it up here. It's pretty simple. Basically, this is what you're using whenever you have that use state death tax credit table set to yes. Okay. But again, you don't need to do that. If you just want to make it no, you can do that and plug in a flat rate or just an amount with an exemption. Okay, other rates. We have the IRD rate here, and I'll only touch on this one. These other ones don't come into play all that often. But you have your IRD rate on the estate reports. Whenever there is a qualified plan that's passing to a child, we make an assumption on the taxes that will be paid by that child. And so we're assuming that this is the rate that that child will pay in IRD tax when they inherit that tax-deferred plan. If you think that's a bit high, then you might and go and you can control that, drop it down. Really all we're trying to do here is tell the story of, hey, if you leave your child $1 million in an IRA, they're not going to get $1 million. They're going to get $1 million minus taxes, and this is where you control that tax amount. Okay, moving right along. A lot of stuff on taxes here, so we're really in the weeds. But like I said, this is the point of this webinar, is to kind of give you that information so you really understand what's going into the simulation. Tax adjustments. like I said, we have a pretty good 1040 calculation. If you want to know some of the things that we include in the 1040 calculation, I'll show you it here. Move this over a bit. So you can see all of these things we factor in our 1040, including, of course, the marginal brackets, like I mentioned earlier. Okay, but if there is a deduction or a credit that you don't see there on the federal level, you can add your own. So, for example, we can use my favorite, the child tax credit. We don't do that one, but if you did want to model that child tax credit, you could do that. And you could model it here for however many years that would occur, and then you could save that. Okay, you could also do above-line deduction, below-line deductions, or just simply a dollar-for-dollar adjustment on the taxes. Okay, maybe there's some more complicated situation and you just want to show that, you know what, their tax bill is going to be $5,000 less. Okay, we could do that. You can do the same thing for state income tax. The only difference here is you're slightly more limited. You can only do an adjustment. So if you want to increase their state income tax dollar for dollar, you can enter that in. So if they're going to pay $1,000 more in state income tax this year, you can just plug that in. If they're going to pay $1,000 less, then that would just simply be a negative. All right, and we are halfway there, now working on fees. So important to remember here, these are advisor fees. So you can plug these in as a percentage that is deductible. So if there is a certain percentage of your advisor fee eligible for deduction, plug that in. It will be factored into the income tax calculation. You can plug your schedule in here. So if you have a fee 0 to $1 million is 1%, anything above $1 million is 0.75%. That's great. Maybe you want to do up to $2 million. Okay, so maybe that's 0.75, and then anything above $2 million, 0.5. Whatever it would be, okay, you can plug in that advisor fee. Now, it's important to remember this advisor fee is only going to apply to assets that you have specified as being under your management. So when you go into the investment, there's a drop-down that says under management, yes, no. You need to make sure it's yes, and then you actually need to go into that investment itself and select your fee schedule. Okay, so that's advisor fees. You can also do these at the global level, and we'll touch on that a little bit later. Okay, so simulation. This is a rather confusing topic, so I'll spend a little time explaining the different simulation options you have in eMoney. If you look at this drop-down, you have January 1st of this year, January 1st of next year. Pretty simple, right? If we're doing January 1st of this year, we're going back to January 1st, 2016, and we're showing full income, full expenses, full growth. This works great, except when you're in December and we're showing a full 7% growth on your investments for the current year. So that is one drawback to this, but essentially it's an annual simulation. It's going to show the full year of income, expenses, etc. January 1st of next year does the same thing, except you're starting in 2017. So it's going to assume that no growth happens this year, that there's no income, there's no expenses this year. Everything starts next year. Okay? The order of these for annual simulation is the following. You have your growth on your investment happens first. Then if there's contributions, okay, they happen next. And lastly, withdrawals or expenses are taken out. So that's the order. It's growth, contributions, and then withdrawals / expenses. things change a little bit if you do this month. And because this month can be a little bit complicated, I've got a PowerPoint slide here that kind of shows you why you might want to use monthly simulation. So monthly simulation prorates income expenses in the current year. So we are in June of 2016. So if I make $50,000 a year, my cash flow is only going to show $25,000 in the current year. If I was using January 1st of this year, it would show the full $50,000. Okay, we also prorate growth on assets. So if I have 12% growth on my account, since we're in June, we're halfway through the year, I'm only going to get 6% on it this year, and then next year I would get the full 12, because that would be a full year of growth. Okay, so those two things are prorated in the current year. Monthly simulation also allows for a future mid-year retirement. So if my client is going to retire when he's 65, and I'm using monthly simulation, he will actually retire on his birthday. So if his birthday is in June, I'll show a half year of income that year, and then that'll be it because he retired in June. Okay, you can't do that if you're using an annual simulation. Okay, this only applies to mid-year, to monthly simulation. There's also growth adjustments for monthly cash flows that happen with monthly simulation. So this is getting into a little bit more detail, but I want to make you aware of this. When you do monthly, contributions and withdrawals are assumed to happen periodically throughout the year. So the example here is if $50,000 withdrawal is taken from an account, in the annual simulation you would take the $50,000 out all at the end of the year after the growth has happened. But with a monthly simulation, we're going to assume that that $50,000 gets taken out periodically. Okay, so you're not going to get the full growth on that full amount because there's going to be a little bit taken out every month. And so we have a growth adjustment that takes that into consideration. So it's a little bit more accurate, probably when you're doing contributions and withdrawals from different investments that have growth rates. So you get all of that with monthly simulation. The best practice here, I don't know. It kind of depends on what you want to do. I think annual simulation is a little bit simpler, but if you understand how monthly simulation works, then this might be a better fit for you. Okay, so we're going to jump back in here. Just a couple other things to cover. The minimum asset level for solving purposes, if you remember when I was going over Monte Carlo a little bit, the standard for a successful Monte Carlo trial is the client having more than $0 at second death. So as long as there's money left at death, then it's a successful trial. If you wanted to change the Monte Carlo standard, so for example, if you wanted to make your standard be, I want my client to have $1 million, or I want them to have $1 million left when they die, then this would change that. Okay, this would also work in some of those solution reports. So that we have a, options for meeting need retirement report. So we would solve for you how much your client would need to save if they wanted to end up with $1 million when they died. Okay, so this is the same thing actually as a leave to heirs amount. So I'll show you, if you are familiar with the simple facts menu, there's this goal, leave to heirs. This is the same, this $1 million. Okay, that comes from what we did here in assumptions miscellaneous simulation, making that $1 million. Okay, the core cash account growth rates, you probably want to just leave these at 0. Best to have the core cash not growing. Intestacy, not a whole lot here. Basically, I think the right approach here is, instead of relying on intestacy tab, just create a will, and that way we'll actually distribute assets based on what the will says, as opposed to using some formula here. The gifting tab, if your client has made gifts prior to the simulation, so your client comes to you, they've already gifted $1 million in the past 10 years or so, plug that in here. If it's a future gift, okay, you can do a future gift here. All right, oh, they're making gifts starting this year and going forward. Great, do that. But if they've already made gifts, we need to know what that is because it's going to affect their estate tax calculation. So this is where you'd enter those gifts, both regular gifts and also GST gifts. Split gifts, this is assumed to be yes. So if it's a married client, that annual exclusion is not just going to be 14, it's going to be 28 because they're splitting the gifts. Okay. So that was a lot. Like I said, we're going to be in the weeds, and we definitely covered a lot of these assumptions. Maybe you have some questions about anything we looked at. Take some time. Feel free to shoot me those questions. Like I said, we'll go over those in just a second. While you're typing up those questions, I want to show you one other thing here, and that is the settings area. So up here, we have settings, and a lot of what we just covered can be done at a global level. So if we go down here to fact defaults, the important thing to remember is, what do I want all of my clients to have as their default assumptions? Okay, you can control that in the settings area. Retirement and death, we saw all of these before. Okay, tax rates, okay, you know what all these do. How do you want all of your clients going forward to be set up? Okay, you don't need to go into each client and do all that information. You can actually set it up here in the settings, and this will apply to all new clients. I'll just highlight that again. The save changes here in settings will only apply to new clients. So if you have existing clients, you're not going to change any of those assumptions. You're only going to change assumptions for new clients that you create in the future. And that bit that I said about your advisor fee, you can do your fees here at a global level that will apply to all your clients. This is what I would recommend doing if you want to put in your advisor fee schedules. You can definitely do that here, and then you can have that apply to clients. You can also do some default growth rate assumptions. So if you want every single type of asset to have a certain growth rate, you can model that. If I want all my retirement assets that I entered to be defaulted to income, my income portfolio that I've created, then there you go. You can set it up, okay? If not, we can leave it at asset mix, and you can go through and change that as you see fit. Okay, so I'm going to take a look at the questions here, and we'll take 5–10 minutes and go over some of these questions. So bear with me just a sec as I look these over. Is there several coming in? First question, can we choose which rate of return you use for Monte Carlo? So that's getting back to our investment assumptions area, and I'll just go there again. You can't choose which rate you use for Monte Carlo. We are only going to use the mean rate of return, and that's actually the mathematically correct way of doing it. Geometric rates of return should only be used when you're doing that linear projection, but when you're doing a stochastic modeling, like you are with Monte Carlo, you want to make sure you're using the arithmetic return. Some other questions that have come through. Do the asset class returns in our plans reflect any estimate of fees/operating expenses, or are they straight index returns? Great question. They do not reflect any fees. So these returns that you're using, whether you're using your market indices or whether you're using some portfolio rate, these are gross rates of returns. These are not net rates of return based on fees. So if you did want to model a fee, you would want to actually do that in the investment itself, either as an account fee. Actually, that would probably be the only way you would do it. And let me just show you that here because it's a good question. If I go back into the Millers, and I go into their facts, and let's say an investment here, taxable investment, you'll see there's this fees tab. So where you would model an account fee would be right here. Okay, so our gross growth rate is 9.39, but if we want to say, well, there's some management fees with this particular account, we're going to make that 1%, and you can see how that affects the growth rate. Another question here, if I don't want to change the CPI rate of return but want a more conservative growth rate for expenses, would it be better to just make it a custom growth rate of 2%, for example? Yes. So I had mentioned inflation controls a lot of things, and if you wanted to bring inflation down, or up for that matter, you can do it. You can just change the CPI. But for actual entries here, you don't have to use inflation. Frank's income, for example, I have inflation as an option, but if I don't want to use inflation, I don't have to. I can just say, well, it's going to grow at 1%. Okay, same thing for expenses. I could do living expenses indexed at, instead of inflation, I could just maybe do custom 2%. Okay, so very easy to do that. Question here, would updating the market indices each quarter remove the changes that the investment specialist created? Okay, that's a good question. If you have an investment specialist and you're using those office assumptions, then the only way that you're going to be able to change anything is to opt out of those assumptions. Okay, so if I am using my advisor assumptions and I go to office assumptions, it's going to say that I'm going to delete my advisor assumptions. Okay, now to go back to advisor assumptions, I'm going to have to do this. So the only way I can do any updating to my assumptions is actually to actively opt out of my office assumptions. Okay. I'll do one more question here, and then we'll wrap things up. Okay. Can you add a retainer fee rather than percentage fee for advisor fees? You can't actually do a retainer fee in the advisor fee area. But what you could do is simply just add that retainer fee as an expense, right? So instead of doing it as a fee, just come down here to expenses and other expense, and you could add your retainer fee, whatever that may be, as another expense. And so it wouldn't be based on assets under management, it would just simply be a flat fee. Okay, well, we're going to wrap things up, thanks for tuning in. I hope this was beneficial for you. Just a reminder, as I said at the outset, this will be available as a recording on EMX University, so you can go there and you can watch this again. If you have nothing better to do, you can do that. But if you have other questions or you want to continue this journey through the facts, I would encourage you to tune in next week. We're going to be looking at, I'll just pull it up again, we're going to be looking at building the balance sheet, so adding assets that your client has. We spent the whole time doing assumptions. Hopefully you have a good handle on the assumptions we're using. Next week we'll actually start adding assets and going over some of the details related to that. All right, well, thanks everybody, and we'll see you all, or we'll talk to you all next week.